Given what's taken place over the past week, has your approach and the attractiveness of China as a place to invest changed at all?
I think that it means growth's probably going to be a little bit lower than it otherwise would have been. But nevertheless, if we take a sort of 3 to 5 year view, so for investors with that kind of medium term horizon, we think that earnings growth in China is still going to remain pretty good. And therefore, we're looking at a lot of companies which are cheaper now than they were 6, 7 months ago. And we just don't think that in many cases, the current valuation really gives enough credit to the extent of earnings growth we're going to see over the next 5 years. So we're finding some attractive opportunities, certainly, for investors that can look through what may be a choppy couple of months and take that longer term approach.
Awesome. So basically you're saying this is all a little bit of a storm in a teacup and it'll pass soon. We're getting a little bit over dramatic about the situation in China. Where exactly are you seeing these opportunities? Are you seeing it in equity markets, in credit markets, or in bond markets? And are you seeing them more in Hong Kong or in China?
So particularly on the equity markets, we think there's quite a lot of the companies that we look at have very strong earnings growth, and their share prices have come down more than we think is really justified by the news that we've seen over the last 6 or 7 months. Of course, there's additional regulation, and there may be more to come on that front. But when you actually sort of look at it on a company-by-company basis, to what extent do we think those regulations are going to impact long-term earnings growth? It's less than the move that we've seen in share prices would imply in many cases. And so, some of the very big names in China that have been hit really very hard, we think that if you have a medium to long-term investment horizon, they look pretty attractive at these kind of valuations.
Mike, I do wonder how this changes approach to other markets outside of China. You mentioned perhaps some slower growth. And one thing that I was struck by were comments coming from Bank of America's Savita Subramanian, who said that essentially common prosperity could mean more pain for U.S. multinationals, that just China GDP has meant more just in terms of sort of the global equity market picture. So that could have an impact on, for example, the S&P 500. Do you give any credence to that argument?
I think with China, what's important is to put everything in context, right? So I wouldn't disagree with the notion that Chinese GDP growth will be a bit slower if we have less kind of real estate development driving growth. On the other hand, you've got to put that in context, that what we're talking about is China said they want to double their economy by 2035. That means they've got to grow at about a 4.7% annualized pace between now and then. We think that's broadly achievable, give or take maybe 0.2% on an annualized basis. So we think they're broadly going to get to where they want to be over the next 15 years, which is doubling the size of the economy. Now, if the common prosperity narrative means that that growth is more inclusive, then that may have an effect on some companies. On the other hand, it means that we're going to see more lower income people rising up into the consumer class. We think that by 2030, you're going to see 1/3 billion more people join the consumer class in China. So there's plenty of opportunities for those people to then go and spend on companies, and that to boost earnings growth, as I say, for those long-term investors.
Mike, you sound relatively complacent about the threat coming from Asia, and so I presume you're pretty constructive overall going into year end. There's 3 months left in this year. What is your top kind of trade going into year end? Where do you think is the asset that's been most discounted by current turmoil that shouldn't be so discounted, and you've got that opportunity over a 3-month horizon?
I think, to be honest with you, over 3 months is very hard to say. But if we look through to the end of next year, which is a kind of time horizon where I think you can have more confidence, I do think that Chinese and Asian equities have come down a long way and that there's upside over that kind of time horizon. But broadly speaking, I think that most equity markets are going to perform reasonably well. Less strong than we've seen this year. You've got very strong performance for DM equities so far this year. I think going forward, the returns will be lower, and there may be a bump or two along the way. But nevertheless, I think the key trade between now and the end of next year is to be underweight government bonds and overweight equities. Now, within that, I think that the move we've seen over the last day or so, where bond yields have moved higher and value stocks have done pretty well on the back of that. I think between now and the end of next year, that's a trade that's going to continue to play out.